here we're looking at a downtrending market. And we need 3 candlesticks to form a sequence. We're looking for a down candlestick. The next candlestick is going to have its low below the first candlestick. And it should be the lowest low of the pattern. The third candle or bar, it closes above the candlestick that's in the middle. In reality, you could actually have several bars heading down or up. So let's just take a look at this gold futures chart. Now here, the pattern does not exist because that green candle did not close above the high of the middle candlestick. The idealized pattern forms right here, and at the reversal, you will look to establish a long trading position. And the pattern appears in what starts as a downtrend. And you can see the support zone that price breaks before the pattern appears at number 3. Using the 3-bar reversal in conjunction with support and resistance. But what we have to see is that the middle one that you're looking at, the lower the high, okay, that's the turning point in the pattern, is to add some type of confirmation. And generally, that's going to be that the third candlestick or bar closes above the high of the first and the second candlestick. Think of an engulfing type of candlestick. A larger pullback could entice more traders to jump into the continuation. So the key for me is that in the example of looking for a short position, the first candlestick closes green, which is a bullish move. The second candlestick needs the highest high, and it forms a pivot, right? A price pivot. And that's our turning point. The last bar closes under the low of the first bar, and that's enough momentum to wipe out the gains from the prior 2 candles. Well, one key element is to look for a market that is trending. And you can determine that by simple price action using higher highs and lows for an uptrend. So looking at this 1-hour Forex chart, here's what we got. The red X. Now this shows an incomplete pattern, as that third candle, it failed to close above the high of either of the candlesticks. The green line shows a completed pattern that you could trade. Now the price pattern completes and a buy stop order is placed above the high of the trigger bar, number 3. Okay. Your stop loss could go below the low of the pattern. In this case, it's a long, so it would go below it. Your profit target could be a trailing stop under the low of each swing once the high is broken. Now, we could consider making the pattern more reliable if the pivot, the second candlestick, is actually coming into previous higher lows or confirmed support and resistance levels. Now, since the trade position is entered at the break of the higher low of the third candlestick, your stop loss could be well away from our entry price. So if a successful 3-bar pattern is a close above both candlesticks or bars, I would consider a close below the high of the pivot candlestick a failed pattern for an uptrend. And we could be entering a trading range, and I would just exit the trade. I wouldn't wait for my stop to get hit.